This is gold. Okay, this is on a daily. This is continuous
Yeah.
contract, but you can see
Yep.
I have it next to dollar yen just because, trust me, they have a correlation. So that was it. Like, oh my God, March 1st, and we went and stayed higher.
Yep.
And then today, I don't know if
Yep.
it was Russia's, not threat of world war or anything, but just saying if we see an F-16, it's going down, just letting you
Yeah.
know, and deploying some big aircraft carrier. The point is, look at this spike.
Yeah.
Talk to me about that.
This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
We've talked. I mean, I've been bullish on gold for
I know,
a
but now it
long
really matters.
times, and I think now it's just benefiting from all of these factors, right? I mean, gold is certainly being reintroduced into a multilateral currency regime where excess trade balances are being settled in gold and not in US treasuries anymore, as Russia trades with China and Iran trades with China, Russia trades with India, OPEC trades with China. There's just more and more transactions that are being done away from the dollar. And when those excess trade balances get too large, country comes in and says, we'll just take gold for it. And that what you're seeing is exports of gold from Switzerland they're all going to the east. They're all going to China, to India, to OPEC, to Turkey. They're all going east. And they're all going to countries and areas that are trading with Russia, right? It's clear to me that gold is being reintroduced. There has been a massive breakdown in the correlation of real yields and gold, and TIPS yields and gold. We've talked about that divergence, and that's because gold recognizes that inflation in the US is going to be structurally higher and that there's no way out, and that real rates in the US have to eventually fall because the government cannot afford high, 200 basis point positive real rates. And gold's anticipating that. And so when Powell came out and was dovish, gold and Bitcoin together they got the joke. They're like, the government is basically saying, they're going to support the treasury market. They don't care about bringing inflation back down to 2%. And we got to get out of treasury fixed income and own hard assets for the long term. So I think that is the dynamic in play in gold. And if you were to think that China and Japan are pricing energy in local currency and settling trade balances in gold, then you'd be seeing gold go up in those currencies. And so gold in yen, gold in rupees, gold in RMB, those prices are even better than gold in dollars, right? I mean, so I think that is the dynamic in play. It's this repricing of oil, repricing of energy away from dollars, the use of gold as a neutral reserve asset increasingly, and less use of US treasuries as a neutral reserve asset. And that game got accelerated after the BRICS meeting in August. Everyone laughed about the BRICS meeting and said, oh, see, they didn't introduce a BRICS currency. And I think really the reality is BRICS is laughing at the US and is laughing at the West. They engineered an attack on the bond market. They brought Saudi, UAE, and Iran into BRICS. They reminded the world that now BRICS controls well north of 60% of global oil exports. They control the entire Middle East. All those countries around where the waterways are, where Egypt and Ethiopia were included as well. They include all, it's in BRICS control. And what they said was, we're going to drive oil prices up, drive gold prices up, and sell US treasuries. And let's see how the US likes it. And Yellen and Powell, they didn't like it. And so, because that was the 10-year and 30-year moving above 5% in late September, early October. And so they went to the IMF meetings in DC in October and told the rest of the IMF members, or the IMF members were telling them, we need the dollar to be weakened here. We need you guys to do something. We need to figure out, because otherwise we're going to keep selling treasuries because oil is too expensive. And so they've articulated this plan where they're going to allow more and more countries to trade energy away from dollars so that these countries are not pressured to sell their treasury holdings. Then at G20 in San Francisco, we rolled out the red carpet for Xi and for MBS. And we told them both, it's cool now that you sell energy to China in RMB as long as you don't recycle those excesses into Chinese government bonds. And instead, you recycle them into gold. Because if you recycle them into Chinese government bonds, that's going to give China the ability to restock its military. And we're not really cool with you doing that. But we are cool if you take those excesses and put them into gold. And subsequent to that, since November, or really since late August, look at the gold price since late August. You know, it's clear that everyone who was laughing that BRICS didn't introduce a new currency is slowly realizing that they actually did. And it was reintroduction of gold as a neutral reserve asset. And that's the reality that we're trading in. I think people are slowly coming to grips with that reality. What was something that I wrote about earlier this week, it dawned on me, I wasn't putting all the pieces together, but I think the US has fought wars and has spent trillions of dollars in military over the last 40 years to protect the petrodollar system, to prevent countries from trading oil in anything other than dollars. We went to war in Iraq because of that. We've taken out, Libyan leaders and other leaders. We've threatened other OPEC countries for trying to sell oil in any other currency but dollar. But the attack, for lack of a better word, in the August, September, October period has enlightened the US to realize it is that they made a mistake by sanctioning Russian reserves in early 2022 because of the war in the Ukraine and removing them from SWIFT, which means that no one's ever going to trust the US again. They're never going to build US Treasury reserves. And so now it is in the US's strategic interest to have other countries price energy away from dollars, so it reduces the ability or the need for those countries to sell their reserves until the US figures out how to find a new buyer for its exploding deficits. And what it's going to do, eventually, it's going to introduce the SLR again. It's going to force banks to buy more treasuries without restriction. The Fed's going to wind up coming back in and having to buy more treasuries eventually. And that is kind of dollar endgame, certainly against gold and against hard assets. And that is what I've been writing a little bit about over the course of the last few days. And I think, look, I mean, the reaction to the writing has been a lot of and obviously Luke Groman is I mean, he's the godfather he's my muse on a lot of this stuff. And he's been talking about this for years, and it's been getting pushed back for years. And I wrote about this in when the war started and said Russia isn't attacking Ukraine, it's attacking the US. And we've talked about how this is an attack against the dollar and that Putin and Xi no longer want the dollar hegemony because it's screwing over the rest of the world. And there used to be a lot of pushback to this thesis. There is a lot less pushback to this thesis. There was a lot of folks on the thread were like enlightened, eye-opened, holy shit, like this makes a lot of sense, as opposed to the traditional, the dollar will always be the reserve currency. Like there was a lot less of that this time. So I think we have moved the Overton window on this idea. Clearly not fully fleshed out. I don't know specifically. I'm looking for more proof that Japan is doing this. I mean, Japan exports to UAE for machinery are up 35% year over year, and
China too.
So you're seeing those kernels that this is the reality, but no one ever comes out and just says it, right? It's hard. This is like 4D chess that's going on at the highest levels of power that we're just not privy to those conversations. But there was a lot less pushback this time from the threads, and a lot more support and a lot more people who are kind of, I think, thinking more holistically about what's going on here. So now, are we going to be able to make money with this idea? in the next 2 to 4 weeks. I don't know, but I think it just creates an environment where you know that gold is a buy the dip asset. So gold, I think I saw today on my overbought oversold indicator is close to 99th percentile again, right? So we, those are just, I think people are getting more constructive. So if we get a pull, we could get a pullback tactically on a hot PCE and whatever. Just be mindful of that. But owning gold vol is still pretty cheap. Oil vol is pretty cheap. So I think owning these assets in calls and call spreads, I think makes a lot of sense. These are just kind of buy the dip assets here. And that's kind of how, thankfully I've had those on and kind of offset what I thought was going to be a more negative equity earnings environment that really just hasn't really played out as I would have thought.
We'll see about that in May.
The full episode is available to Edge paid members. For more information, visit LaDucTrading.com/edge.